Oracle announced earnings for their first quarter of fiscal year 2024, in other words, the third quarter of 2023. Their stock is up 70% over the last 12 months, while the rest of the market is up 16%. So they're clearly outperforming the market over the 1-year chart. And so in this video, I'm going to look into some of the recent news that came out surrounding Oracle. I'm going to look into their business model and their financial statements to get a better understanding of their financial health. And then I'm going to use a relativistic comparison valuation model in order to calculate the intrinsic value per share for Oracle so that we can know if Oracle presents a good buying opportunity at the current share price. So right here in this article, some recent news came out surrounding Oracle's earnings announcement. The CEO talked about increasing demand for their cloud business after the company's stock tumbled last week. They point out right here that they said there was so much demand that they just kept on booking it. In fact, in the first quarter, or in the first week of this quarter, they booked another $1.5 billion just in artificial intelligence workloads. So, and also they keep winning every single competition against others because their system is so much newer and faster. Oracle saw their stock drop 12%, which is their steepest drop since 2002, after they reported first quarter earnings and weaker than expected guidance for the second quarter of their fiscal year 2024. Also, they recently announced that they're going to be putting their database services on the cloud infrastructure, Microsoft Azure, obviously provided by Microsoft. And on top of that, over the last year, Oracle invested pretty heavily into setting up the basics for their cloud business, and they're now starting to fill out the data centers with their software. As they pointed out, they aren't going to be recognizing a lot of that revenue up front, but over time, they're going to start seeing big payoffs. So basically, recently, Oracle has been making big investments in building out the infrastructure for their cloud business model, and they're starting to see that demand come in, which is going to hopefully increase over time. So right here we can see their financial statements, but before I get into these, I thought it would be wise to look at Oracle's business model so we can understand how it is that they actually make money. So Oracle sells database software, cloud systems, and business enterprise software products, including ERP software, CRM software, and supply chain management software. Oracle sells their products to the private and public sector. Some of the examples of how customers use Oracle's software products are found in software companies that offer their software as a service using Oracle's cloud, banks that run banking applications using Oracle's database machine, and accounting teams that use Oracle Fusion ERP for financial planning and bookkeeping. Oracle sells their software products using subscription models and also one-time purchase models. And one of their most popular products is Java, which is one of the computer industry's most popular programming languages, which if you're a software engineer, you've definitely heard of Java before. So right here, we can see in their financial statements, this is their balance sheet. They're comparing May 31st to August 31st. Total assets in their most recent reporting period were $136 billion. And then if I scroll down here, we can see that they only have about $2.8 billion of total stockholders' equity. So obviously a very large portion of their business, about 99% of it, is financed by liabilities. Right here, this is their income statement. We can see that total revenues increased 9% year over year from $11.4 billion to $12.4 billion. And then we can see net income increased by 60% year over year from $1.5 billion to $2.4 billion. Also, I know it doesn't say it here, but in total of their $12.4 billion of revenue, about $4.6 billion of that came from their cloud revenue, and their cloud revenue was up 30% year over year. So the cloud revenue is obviously growing pretty fast, which is definitely a good sign for Oracle. Then lastly, we can see right here, page 9, operating cash flow for the last 3 months increased from $6.3 billion to $6.9 billion year over year. And for their financing activities, they didn't really repurchase that much common stock. They only repurchased $150 million. Most of their financing activities took place in repayments of their debt. So they're trying to reduce the amount of debt they have, which, as we saw, they do have a pretty heavy debt burden on their balance sheet. So right here we can see this is a discounted cash flow model to figure out the intrinsic value per share for Oracle. But unfortunately, as we can see from this model, Oracle over the last 5 years has actually had a declining growth rate for their free cash flow. They had free cash flow of $12 billion in 2018 and $8 billion in 2022. So over a 5-year period, that ends up leaving Oracle with a historic growth rate of -8%. And I didn't really think that it was wise to use a discounted cash flow model to try to value Oracle, since their cash flows haven't really been increasing year over year. As you can see right here, it basically estimates that Oracle has an intrinsic value per share of $2 per share because it's basing that on their cash flows. And that obviously would not be good enough to make them a good buying opportunity. Since they're trading at $110 per share, it would make them extremely overvalued. So I thought it would be wise to instead use a different valuation model for this video. And in this case, I'm going to be using the relative valuation model. Basically, I'm figuring out the intrinsic value per share of Oracle by comparing some of Oracle's financial results to the financial results of Google, IBM, and Microsoft, which are other companies that are competing in a similar industry to Oracle. We can see that Oracle's price to earnings ratio was 32 times earnings. They had a price to sales ratio of six times sales, and they had a price to book value ratio of 125 times their book value, which is basically their shareholders' equity. We can see that I compared them to Google, IBM, and Microsoft, and when you find the average of the ratios for these three companies, you have them on the right-hand side here, average of all of the comparable companies, came out to 4 to 3 times earnings, 6.7 times sales, and 8 times book value. So that obviously means that in comparison, Oracle has a price to earnings ratio, in this case for this chart, that is lower or cheaper than the price to earnings ratio for the industry. They have a cheaper price to sales ratio than the rest of the industry, but a way higher price to book value ratio in comparison to the rest of the industry. And this primarily comes from the fact, as we saw from their balance sheet, that they have a lot more debt on their balance sheet than these other three companies. And that's why their price to book value ratio is so much higher than these companies. We can see this part isn't really relevant to the valuation model, but I thought I would include it just to add some extra information for you guys. We can see that if we compare the companies against each other in terms of earnings, both Oracle and IBM both had declining earnings growth over the last 5 years. IBM's earnings growth has been declining by 28% year over year, which is absolutely abysmal. And then Oracle's 5% decline year over year. Google and Microsoft increased by 13 and 14% year over year. And so average amongst the comparables comes out to 11% for the industry. So obviously Oracle is underperforming this industry based on these three companies in terms of historic earnings growth. Lastly, for historic free cash flow growth, we can see these are the results for the historical free cash flow growth for the last 5 years for these three companies. Comes out to 12% on average for the industry, and then Oracle is underperforming that with -8%, which is why I'm not using the discounted cash flow model. So basically, in order to calculate their intrinsic value per share, I have 3 intrinsic value conclusions or assumptions right here. We can see that if we take the earnings of Oracle, which were $8.5 billion, and multiply that by the average price to earnings ratio, which was 43 times earnings, that gives us an intrinsic value for Oracle of $367 billion. And then if you divide that by the amount of shares they have outstanding, that puts their intrinsic value per share based on price to earnings ratio for the industry at 133 times earnings, which means, or $133 per share, which means that at the current share price, Oracle would be trading below intrinsic value per share based on their price to earnings ratio and their earnings results for their latest year compared to the average price to earnings ratio for the rest of the industry. In terms of price to sales, we can see that if you multiply Oracle's sales by the average price to sales ratio for the industry of 6.7, you end up getting a value of $336 billion valued for Oracle's company. You divide that by the amount of shares outstanding, you get a valuation or an intrinsic value per share of $122 per share, which still puts Oracle at a good buying opportunity because they're trading at less than $122 per share. But lastly, in terms of book value, the metrics here are pretty heavily skewed against Oracle's favor, mainly because their balance sheet has so much debt. So if you multiply their shareholders' equity metric by the average price to book ratio for the industry, you end up getting a valuation of $8.7 billion for Oracle's entire company, and then an intrinsic value per share metric of $3.19, which is similar to the metric that we got for the discounted cash flow model. So I wouldn't really use those metrics because the free cash flow for Oracle isn't really increasing, and Oracle is in a unique position where they have a lot of debt on their balance sheet. But in terms of sales and earnings, it looks like those metrics seem to align a little bit more with where Oracle is currently at. Obviously, these models use a lot of assumptions, so I would definitely encourage everyone to do your own due diligence before using any of these models to make any serious decisions in the stock market. So next, I wanted to compare Oracle to some of the other companies in their industry, particularly here Google and Microsoft, based on some of their other financial ratios. We can see that Oracle has a competitive gross profit margin at 65%, but they have the lowest net profit margin and return on assets. They have the highest return on equity, which isn't surprising because they have the highest debt to equity ratio. They're also trading at a pretty high price to earnings ratio at 32 times earnings, and they pay the highest dividend out of these three companies at $1.28 per year for every $100 you invest into Oracle. So based on this, it obviously looks like Oracle is very competitive, but from a financial ratio perspective alone, you'd probably want to give it to Microsoft because they have the best profit margins. Lastly, I wanted to compare Oracle to some of the other companies we've looked at in past videos. In terms of intrinsic value per share, I'm not going to include them on this table because this table is basically, it uses all of the metrics from companies that were valued using the DCF model. In this case, we used the relativistic model, so I'm not going to include it in this table, but we can see the list of companies so far that we've looked at that have been trading below intrinsic value per share. Next, we can see that for growth rate, Oracle's growth rate was basically negative over the last 5 years at negative 8%, so not good enough to get them onto the table. We can see the results right here. AMD had the highest at 83%. For dividend yield, Oracle's dividend yield was about 1%, not good enough to get them onto this table. Intel had the highest at 5%. We can see that for profitability, Oracle did have a very competitive gross profit margin at 65%, which was competitive to the best gross profit margins we've seen out of any of the companies we've looked at. But for net profit margin, it came out to about 17%, not good enough to get them onto that table. We can see, however, that for Q3 year-over-year revenue and earnings growth, Oracle came in second place, increasing their revenue year-over-year at 9% and 60% for earnings growth, which puts them in first place so far for all of the companies we've looked at for Q3, which so far is just Adobe and Kroger. But if I scroll down here, we can see that for Q2 year-over-year revenue growth, Oracle also made it onto that table for the finalist with a 17% second quarter year-over-year revenue growth and 9% in the third quarter. So they're staying consistent, growing their sales year-over-year from quarter to quarter, which is a good sign because that's the whole point of doing this comparison. We're able to see which companies are consistently growing quarter to quarter. Unfortunately for earnings, their earnings growth in the second quarter was less than 45%, so they didn't get onto this table. But we'll see if 60% is good enough to keep them competitive in the third quarter. Lastly, for stock performance over the last 5 years, Oracle was up 115%, not good enough to get them onto this table. Tesla had the highest at 1,000%. So obviously, comparing companies against each other like this isn't really fair because they come from different industries, but I still like to do this analysis just so that we can get a bird's eye view of the entire market. So let me know in the comment section down below what you guys think of Oracle. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.